Good afternoon. I'd like to thank you for joining me on another episode of the 2020 Economic Recession and Preparation channel. Looks like the Dow Jones is currently up around 83 points or so as we get ready for a close in about another 30 minutes to an hour. But as you can see, all is not well as we head into the fourth quarter of the economic cycle of 2019. The Dow Jones has been reaching record highs these past 3 to 4 months. Monday's rise brought the Dow Jones year-to-date gain to nearly 18%. That would be the biggest one-year gain for the Dow since 2017 when it jumped 28.2%. As a matter of fact, the S&P 500 is up more than 22% for 2019 and is on pace for the biggest one-year gain since 2013 when it rallied nearly 30%. And also, we can't forget about the NASDAQ. The NASDAQ is also up more than 27% this year. So we can see that there's a lot of enthusiasm surrounding the stock market. We can see that everybody's tweeting out, quote unquote, the stock market hits record high. We're at all-time record highs. Now, this is despite the lower manufacturing numbers. This is despite the rise in jobless claims. People looking for work are taking longer. This is despite that we have no China-U.S. trade deal going on and won't have one possibly going into next year either. So there's much cause for concern. And today I want to talk about 3 points. I want to talk about the Fed's next rate cut. I want to talk about credit tightening. Banks are tightening credit. And also there's been a lot of reports of bank glitches in their system in terms of the ATMs and stuff of that nature. And also I want to talk about cash liquidity problems and inflow problems and how we can address those concerns and also mitigate damages due to our financial record here. So, as we head into this last quarter, we expect the Fed to cut rates once again in its December 10th meeting. We're just about a little over a month away from that meeting. And you can expect another 25 basis point, maybe even 50 basis point rate cut heading into the holiday season, as liquidity problems are not only dealing with the bank's liquidity problems, but also they're having liquidity problems on the credit card cycle end, as a record number of Americans are in a huge amount of credit card debt. And so this comes from MarketWatch.com today. It says that banks tightened standards on credit cards in third quarter. This is a Fed survey found that uneasiness about economic outlook was a factor in pulling back on lending. Okay. Banks are more worried about new borrowers' abilities to make payments on their credit card loans. So let me get this straight. So you get a credit card, and you let's say you get 0% APR for the first 6 months to a year, and then after that you get a 25 to 28% APR on that card. And you wonder if you can make payments. If payments they're having a hard time making payments. Banks are worried about that. I don't think they're worried about borrowers making payments as much as them not making as much interest and money off those payments. It says here, according to the article, that banks have increased underwriting standards for approving credit card applications for the last 3 quarters of the economic cycle. Credit card standards tightened the most since 2009. Remember, in 2008, we had the big financial crisis and credit tightening. So, in addition to raising standards for credit cards, banks reported that they are less likely to approve credit card and, get this, auto loan applications by borrowers with FICO scores of 620 than they were at the beginning of the year. Banks cited a less favorable and more uncertain economic environment as one of the reasons for reduced willingness to make the new loans. Well, the Fed has already been injecting the banks with $60 billion of repo money nightly. And Fed Chairman Jerome Powell says he's willing to adjust those numbers as needed. Okay, so he's willing to offer more or less to increase the liquidity of these banks. But the banks are having trouble in their credit card sector, and that's where they make Now, since they're not making much money, giving people much money on their savings, that's where they make the majority of their money, of charging people these high interest fees on these high interest credit cards and offering little rewards on most of their cards except the very top tier of their credit card services that they offer. So as you can see, and this is the survey, the Fed surveyed 76 domestic banks and 22 branches of foreign banks. So we can see that the Fed is going to do everything they can to keep these banks propped up, to keep them liquid, the money liquidity, so they can have the necessary reserves on hand. But what if that fails? What if you go to your bank and you cannot get not even a credit card, but you can't get your cash out? There's limits on your withdrawal. There's a malfunction on your chip, on your credit card. Do you have an emergency fund? And this is one of the reasons why I tout having an emergency fund. No, I'm not doing like Dave Ramsey talking about 6 months emergency or 3 months emergency, but you do need to have a liquid fund just in case there's an inevitable rainy day in all of this record hiccup that is going on. And so you do need to make sure that you have an emergency fund, whether it's 2 months, 1 month, or 6 months. You need to be putting aside money for a rainy day. And especially in this job market. That's another thing that as credit tightens, okay, small businesses rely on credit, okay? Tell me, when is the last time you went to any downtown city, small or large or medium, and seen a lot of small business activity, okay? When you go to most of these downtowns, whether you're in a big city or a small city or a medium city or a rural town, tell me, what do you see stand out the most? Okay, usually it's banks, hotels, eateries, small boutique eateries, coffee shops, things of that nature, maybe some national chain eateries, Dunkin' Donuts or whatever, Panera, whatever the case may be, downtown, and gas stations. Okay, that makes up for the most part the majority of the core of the downtown, financial CBD, central business district. The death of small businesses, loans, and credit happened back in 2008, 2009 financial crisis. That is just the unadulterated 100% truth, okay? And so now we are faced with a situation where in 2008 and 2009 the credit tightened, but it tightened for the consumer, okay? Just the consumer only, meaning that the banks and the quote-unquote those too big to fail, according to the Fed, their credit was actually extended. And that's why they went on a shopping spree for the last 12 years with your money, taxpayer money, and other money, okay? Now, this time, in this 2020 economic recession and collapse that we're going to experience, the credit tightening is going to be on the consumer, but also on the small business person and the commercial consumer as well, meaning that an average person or a small business owner is not going to be able, or a farmer, etc., is not going to be able to get a credit extension or a loan at all, okay, when this next bubble bursts in the 2020 economic recession. So that is what we're facing, okay? And like I said, the ultimate goal of this whole economic recession, depression in 2020 and beyond is to ultimately introduce a new system of digital money, okay? Notice I didn't say crypto or Bitcoin and none of that stuff. I'm talking about digital money that can be tracked, followed, and can be verified mostly online. And that's why 5G is coming. That's why all this other technology is coming, because it's mainly for control. And so we'll talk about that in later episodes, but I just want to give you a foreshadowing of where that thing is coming. So if credit is tightening, okay, no matter, and this goes on no matter what your FICO score, if you have a 620, a 750, a 800, a 590, credit is tightening for everybody. And this is just the beginning, okay, because banks know that they won't be able to make the money on other products, okay? So they're going to be charging higher interest rates, okay? Now, we know that cash is drying up in the system. And what I mean by that is, you notice that the Federal Reserve is only playing with interest rates, moving interest rates down. That encourages people to borrow, cheap money and lend. Okay, they have not increased or decreased the money supply, at least not temporarily. And what I mean is, yes, they're printing up money for the banks, but that's an interbank loan. These are between banks, not in the general economy. That money has not been injected directly into the economy, i.e. helicopter money, dropping each person 10 grand in their bank account or whatever to stimulate the economy in that way. A direct stimulus package to Main Street has not been offered. Interesting thing is, in Europe, in their economy, they're thinking about doing a direct stimulus package to consumers for Germany, Greece, Italy, etc. In the works for next year, probably mid-20 to late 2020. They're thinking about doing that because things are so bad over there in terms of a stalemate and with their economy. But over here, we have cash liquidity problems. Next time you're in a store, look at the prices. You may go to Walmart, Target, Kohl's, Old Navy. Look at the prices for items, okay, that you normally would get for your kids or for yourself. In terms of clothing, look at basic prices and tell me if you see a change. I guarantee you every other month the price is going up significantly because inflation with the prices is going up, but you notice your wages is not going up, okay? And even if you get a cost of living raise, which I'm sure most will get in January, if you're on a pension or some kind of government assistance, or if, etc., it's not going to keep up with real inflation, which is at 5.5%, okay, not the 2% that the Fed is touting. And it's been this way since 2009, okay? In addition to this, when the deflationary depression and recession hits, there is not going to be enough cash for people to buy up these assets but the super top 1%, and that's what they want. They, meaning the Federal Reserve and the super ultra rich people, the top 1% or 1% who control the U.S. economy and, and in effect, the world economy, okay? So what's going to happen is you're going to end up with a situation where in terms of the money supply, most of us average, regular, hardworking folks are not going to be able to participate in getting a lot of these bargains that are going to be on sale until much later on in the depression. By that time, in the depressionary stage, 2024, 2025, there'll be the scraps left on the bone, okay, for us to pick up. Maybe, in a condo here, or maybe an abandoned house here that, it's not in Detroit, but I'm saying it's in an area that's a little bit undesirable. But that's why I encourage you to be self-sufficient. I encourage you to have an emergency savings fund. I encourage you to grow container gardens while you can. If you're in an urban city, learn how to grow container gardens on your back patio, on your porch. Also, you want to have, because food supply is going to be short, okay? And that's going to be starting as early as next summer, okay? Because remember, we had the Midwest floods and all that. The news media has quickly moved off of that, okay? So not only are we going to have a cash liquidity problem, we're going to have a food liquidity problem here in the U.S. because over 70% of our food is imported from another country, okay? Mexico, Canada, Argentina, Brazil, Colombia. Bananas, all that stuff is imported. China is imported from overseas, okay? Only 30% of the food that you see in your grocery stores is made in America or produced in America, okay? And also, you got to remember, too, not only that, but it's going to be the basic things that kill you. The food, the gas, the medicine, okay? Stock up on those things now because once the supplies get short, you know what? You name it, the price is going to go sky high because they're going to be price gouging and nobody's going to care because the system is down. The economy, for the most part, is going to be down as we know it, okay? So stock up on food, medicine, antibiotics, water especially. I told you if you can't get a good water supply, then that's going to defeat the purpose. All of your other preps are going to be in vain if you can't figure out a way to purify water and have a good water supply for you and your family, okay? You can only live 3 days without water, a clean water supply, and you can live, a couple of days without food. But if you don't have clean water, forget about it. All of your security and all of your preps are going to be in vain. So figure out that. You can use pool sock to purify water. You can get tablets on Amazon, water purification tablets. You can get life straws on Amazon, those things. A Berkey water filter is also good. It's a big filter, stainless steel that you can buy for maybe about $200 or less. And so just different things like that's going to be very important as we head toward end time, okay, as these supplies get limited. So just to wrap things up, we do expect an 80 25% chance now that the Fed will cut rates 25 basis points, maybe up to 50 basis points coming December. Credit is tightening with banks already in the third quarter. This is confirmed by a Federal Reserve survey of 76 banks. So we expect credit tightening to continue in the fourth quarter of 2019 and the first quarter of 2020 as people readjust after the holiday shopping and spree. Expect retail sales to be down, to be tepid. The only companies on the stock market that's probably going to go up, of course, is Amazon and stuff like that. And Shopify. But expect all the other places to be tepid. Macy's, JCPenney, etc. Cash liquidity problems will continue, and the Fed will continue the repo operations through January 2020. You can expect that. So continue to stock up, continue to be prepared, and we will definitely be on here again tomorrow to tell you some more news in regards to the China-U.S. trade deal. And we also are going to be talking about more of what's going on with Europe and the Brexit deal and how that's going to affect the U.S. economy going on the early part of 2020. So thank you for joining me on the 2020 Economic Recession channel. Make sure you tell your friends. Hit the subscribe button as well. And just thank you for your support. God bless and have a great day.